Welcome to A Better You. I'm your host, Cynthia Thompson, and I'm here with my good friend Josh. Now, Josh has been on my show before, and we've talked about things as far as finance goes and how you can help yourself budget and take care of your finances at home. And today we're going to talk about a very interesting subject. But before we start talking about that, I want to let Josh remind you who he is and about David Ramsey. Thank you for joining me, Josh.
Thank you. So my name's Josh Siegel. I lead a group, a financial peace group. I've led it for about 3 years now through our church. I have 3 wonderful children. I'm a beautiful wife. And we, again, lead Dave Ramsey's financial peace class. We've had several people grow through it and several people get out of debt and just change their lives. So it's real exciting to be part of.
You know, Josh, the very first time you were on my show, and I was so impressed with the concept of baby steps. Now, through the baby steps, I don't remember if there's one that talks about insurance. What does insurance fall into that? Because that's what we're going to talk about today.
Yeah, so a lot of people are like, what? Well, this insurance lesson, you know, what baby step is it? It's not a baby step. It's just part of your normal budget. You want to make sure that we're budgeting insurance. The same place that car insurance would fall. It's the same place that your electricity bill would fall. So you want to make sure that you're well covered because insurance is defense. You know, they say in sports that defense wins games.
That's true.
Defense wins Super Bowl. So we want to have a good defense. So the purpose of insurance is to transfer risk. So to take some risk off of us and put it on them. But what we're gonna do is we're gonna cover the small stuff and we're gonna let the insurance company cover the big stuff.
Okay. So a type of insurance I know most people have, especially if you live in the Charlotte area, is auto insurance. Why is that important to have?
Well, you want to have well, for the obvious reasons. You want to have auto insurance because for one, it's the law in North Carolina and it's the law in most states. But you want to make sure that you have the right auto insurance. You want to make sure that you have the right coverage. Now, again, we're going to cover this. We're going to cover the small stuff. We're going to let the insurance company cover the big stuff. So, I mean, if you have an older car, you may want to consider having liability only, or have a higher deductible. You want to consider having a higher deductible. If you have a little bit of emergency fund, you can cover that. Remember, we're going to cover the small stuff. They're going to let them cover the big stuff. Because what happens is we're going to pay month over month over month a higher premium, so that we can have a smaller deductible. Now, you want to make sure. I mean, the average incident happens every 5 years, so you kind of want to do the calculation. Okay, how much am I actually saving versus? But yeah, so some things to consider is to have a higher deductible. Consider liability only if you have an older car. Now, if you have a newer car, and even if you can cover it, you may not want to because, again, they're going to cover the high stuff. So if you have a $30,000 vehicle, you might not want to go liability only. You might want to let them cover the big thing, and then you cover the small stuff. Make sure to shop around. Something we've learned is that when you just let it sit, unfortunately, the insurance company have moved to a model where customer loyalty doesn't matter anymore. And what you'll see is that your insurance will increase over time, even though the value of your car goes down.
That's true, yes.
And you'll also see that even though you've had a good driving record for a long time, your insurance will still go up. And so the insurance company in a lot of industries have found that it's costs them less than to give you a discount than to just find a new customer. So, hey, shop around often and find better rates. You will find them, and people will give them to you. So you want to make sure also that your liability coverage is high, because when somebody gets in a car accident, they're not going to sue you for $50,000. If they're in the hospital, they're going to sue you for several $100,000.
Yes.
So make sure that you have adequate coverage in your liability. So if you hurt somebody, your insurance is going to cover the big stuff, and you're going to cover just the small portion of things.
So tell me, Josh, whenever you rent a car, should you get the insurance that they offer at the rental company or not?
I typically would say no. If you book the car with Visa, you can check with your Visa, whoever your Visa is. They cover it. Also, your auto insurance, most auto insurance cover you the same way that your cars are covered. And then you could also check also with Visa to see if they'll cover the rest. So say your auto insurance doesn't cover everything, then the credit card that you book it on may cover the rest. So
not just Visa, but any credit card.
Yeah, so just call them.
Okay. So, that's plain and simple about auto insurance. You don't have a choice. You kind of got to have it, right?
Right.
So let's go on to homeowners insurance or renters insurance.
Yeah.
So let's talk about homeowners first.
Okay. So homeowners insurance, again, something you want to have. Something happens to your home. Same kind of concept. We cover the small stuff. Let them cover the big stuff. If you have your emergency fund in place, then you can up your deductible. Like for ours, we've upped it to $2,500 so that our premiums will be lower. Again, this is the calculation. The same thing with the auto insurance. Make sure that, every 5 years, one minor thing or major thing may happen. So you just got to kind of figure out what the math adds up to and if it's really worth it. If you can get guaranteed replacement, they don't really offer it anymore. Guaranteed replacement means that when you bought your insurance, it was at $250,000. Your house was worth $250,000. Maybe it's gone up to $500,000. That means that they're going to give you $500,000 if a catastrophic event occurs. Now, typically what they offer is extended replacement, which means you take a $250,000 policy out and they'll extend that up 20 to 30%. But if it's now worth $500,000 or the cost of goods has gone up, you might be out of luck. So another way for that, again, is shop around annually for homeowners insurance. Make sure that you're getting the best rate and make sure that you have the right coverage for your home. Even if you don't go with someone else, make sure you've contacted your insurance company that you're currently with and make sure that they're covering the actual value or replacement cost of your house. Another thing you might want to consider, once you've built some wealth, you might want to consider umbrella policy, like $1 million umbrella policy, so that something happens and it's above and beyond what your homeowners would cover, then that umbrella policy will cover you, and they're relatively inexpensive.
I know I mentioned homeowners and renters insurance. They're not exactly the same thing. So can you talk a little bit about renters insurance?
Sure. So you want renters insurance. A lot of people will go and not get renters insurance. Now you want renters insurance for fires and floods and burglaries because, Dave has a story. I'll tell you. He told you before that he was into real estate. That was one of his big things before he started all this. And he had a gentleman in a house, and he gets a call in the middle of the night and says, "Hey, the house is on fire." And they go to the house, and he sees the poor guys and his family. They all got out safe, thank God. And he's talking to them, and he's like, "Hey, Dave, when do I get my check?" And Dave's like, "I'm sorry, you're not going to get a check. Did you have renter's insurance?" He's like, "Well, no, your homeowner's insurance covers it." And he's like, "No, I can't. My homeowner's doesn't cover it, and I can't even cover it because you don't have an insurable asset. I don't have an insurable asset to cover. Those are your belongings. I can't legally cover your stuff." And he's like, he realized it, and the look on his face, he was real sad. So make sure that you get renter's insurance if you're renting, because you don't want to come home and have your door kicked in, and all your stuff gone, then you have nothing to show for it. And it's really cheap. Like renter's insurance is really cheap.
Should you get renter's insurance if you're staying in an apartment?
Yes, an apartment or house, anywhere. You want that all covered because they cannot cover under their insurance policies your assets.
I didn't know that. So tell me, we're just rolling right along here, and we're going to take a break because we're getting into something that's going to take a little bit more time and real important, and people need to really listen to, is health insurance. So we're going to come back, and when we do, we'll talk about that. Okay?
The smallest moments can have the biggest impact on a child's life. Take time to be a dad today. Call or visit fatherhood.gov to learn more.
But it would be safe to keep your distance until the secret that makes you smile. Reliable sources say that chicken soup has found their way out of this. They are returning.
Getting closer to nature can get you closer to your family. Go to discovertheforest.org.
Hi, welcome back to Better You. I'm your host, Cynthia Thompson, here with Josh, and we're talking about insurance. Now, before we went on a break, we said we're going to talk about health insurance, and oh my goodness. I'm sure you can tell us a lot of stories, but we're going to keep this pretty simple about health insurance, what you should get and shouldn't get, and what does it really all mean. So tell me, what does Dave Ramsey say about health insurance?
Well, did you know that the number one cause of bankruptcy is not being able to pay medical bills?
Really?
In the United States, yes. And it's not what you think. It's not people that don't have insurance at all. It's actually the people that are like on an 80-20 policy, and they can't pay that 20. Something really big, bad happens, they can't pay that 20%. And so that's the number one cause of bankruptcy. So there's some things that you want to think about with insurance if you can. Remember, we're going to cover the small stuff. We're going to let them cover the big stuff. So there's some things that you can do to save some money on insurance if you can do it through your employer or not. If you're self-employed, there's a lot of ways you can tweak your health insurance to save a little bit of money. So you can increase your deductible, your out-of-pocket cost. If you have your emergency fund in place, you can do that. You can increase your stop loss. Now, your stop loss means that after so much, my insurance kicks in and pays 100%. So you can increase that. So you could pay more of that before they cover you 100%. But never, ever decrease your max payout. Now, your max payout, for those that don't know, you might be covered up to $1 million. Don't ever decrease that, because you get cancer or something really bad happens. I mean, that adds up real quick, and you never want to decrease that because then you'll be stuck with it. The other option that Dave really likes and I really like is a health savings account plan. Now, typically the way health savings account plan works is you have a tax sheltered money that you can stick in an account, and it can be in an investment account. And you take money every paycheck or every month and you put money into it. Sometimes the employers will contribute money to it. Typically your deductible is about $5,000, and you pay $5,000 100% out of pocket until you hit that $5,000, and then from that $5,000 on, the insurance company pays usually 100%. So what you can do, and it works really good for people that are either don't get sick often,
right,
or are really sick. So people that don't get sick often have a tax shelter to drop money into it, and it carries over from year to year, and you can keep adding to it. So you can add up to $5,000 or whatever the limit is per year, every year. So it's a good way to save money in it too if you're not very sick. If you are very sick and you're going to the hospital and you're spending more than that $5,000, then at least you're covered 100% after that $5,000. So it's not good for those people that are like right in the middle and they're at the doctor sometimes and sometimes they're not at the doctor, and they kind of fall in that middle range. Usually then the 80-20 kind of policy works well.
So Josh, people like in our age group, should we get disability insurance? Or really probably anybody, I would think.
Yeah, so you want to get long-term disability, not short-term disability. Short-term disability is kind of a gimmick thing. Remember, we've gone through the baby steps. We're working on our emergency fund. We're going to cover the small stuff. Short-term disability usually only covers a short period of time, like 6 months. But if we've done our baby step number 3, we know that we have 3 to 6 months of expenses saved up, and we're going to insure that. We're going to self-insure that. But long-term care, disability insurance is very, very important. It's there to replace lost income due to a disability. Now, only 2% of people think they need disability insurance.
Of course, nobody thinks they need it when they're healthy.
But the reality is 30% of us will become disabled for a long period of time. So it is the biggest risk. It's the lowest insured area in people's lives, and it's a huge risk. I mean, could you imagine? I mean, it'd be almost, I don't want to say better, but it would be, if you died, at least your family would be covered. But if you didn't have disability insurance, you have no income anymore, and now you are permanently disabled, and sometimes you have medical costs and stuff that are associated with that. So we want to make sure that we have long-term disability. Forget the short term, it's gimmicky. You don't really need it. You self-insure that, but long-term disability is very important, and people really need to start looking at this because a lot of people have been in bad shape that didn't have this.
So what's the difference between this and long-term care insurance?
So long-term care insurance is for the elderly. It's for nursing home facilities, that kind of thing. And if you haven't had the talk with your parents, or you're not at that age, you don't need it before 60. You want to kind of wait till you're 60 years old. But once you're 60 years old, we want to look at it. Dave talks about a gentleman that he was counseling, and he was like, "Oh no, I'm not getting that. I'm not getting that. I'm not getting that. I'm not getting that." And what happened is his wife got dementia, used up all of their investments, all of their savings. With dementia, you could live for a long time.
Yes.
And so she was in nursing care, and then she died, and right about the time she died, they're out of money. And so he's now broke because he didn't get long-term care insurance. So long-term care insurance is real important for people after 60 years old. You don't need it statistically. You don't need it before the likelihood of you needing nursing home care and stuff before 60 is low. But after 60, you want to do that because you don't want to, typically what happens is typically it's the man. The man goes in, men die earlier. He burns through all of their investments and all their savings and everything, and then he dies, and the woman is left with nothing to live on. So make sure at 60, or you're getting around 60, or your parents are 60, or so they're getting up in age, that they have that. And you may need to help them cover it. I mean, just because if not, and they don't have anything, then it's going to be on you. It's going to be on us. It's going to be on whoever needs to take care of them.
So you can wait until you're 60. Isn't it less expensive if you're younger, or no?
It is a little less expensive when you get into it, but typically the way the plans work is they actually are adjustable. So if you get it earlier, it's cheaper, but as you gain in age, the price of it goes up. You can't usually get a locked-in long-term care policy.
And with that said, we're going to take a short break because our next topic is going to be on life insurance, which is very important.
Yes.
And there's so many different kinds, okay?
So, same time next week?
Well, of course. Put away a few bucks, feel like $1 million. For free tips to help you save, go to Feed the Pig.
Don't look at me. Your hair's a bit frizzy today. Oh, you should pick that up.
Every day, kids witness bullying.
For you.
They want to help, but don't know how. Teach your kids how to be more than a bystander. Visit stopbullying.gov.
4, 3, 2, 1.
Hi, welcome back to Betty. I'm your host, Cynthia Thompson. I'm here with Josh. And Josh, you're really educating me on insurance. There's so many things that I didn't even know. And I've been here for a little while, too. But one thing that's real important I want us to talk about, and I want to get some clarification on for myself, is life insurance. Most of our jobs offer it to us, but we might want to think about getting some outside of our place of employment also. So just tell me, what is life insurance for? What is it about?
Okay. So there's generally two types of life insurance. You can kind of bucket them in two. You have term life insurance, which has no savings plan, and then you got cash value, whole life. There's a universal life. It all kind of comes into that, where there's some kind of investment or savings plan built into it. Big thing is there's a myth that's like you need life insurance for your entire life. That's not really the case. Life insurance there is to replace income due to death. So once you've done your baby steps, you've gone through all your baby steps, you've saved up all this money, you've had your investments, it's time to retire. There's no longer need for a replacement of income because you've done that for yourself. So the myth is everybody thinks they need it all the way till they die. It should probably be called death insurance, but it's to replace your income. So you should have 10 times your income in the policy.
Wow.
If you consider that the average rate of return in the stock market over the years, if you take the S&P 500, it's been about 10% it's grown. So the idea is if you, let's say you make $50,000 a year, you have a $500,000 policy, it pays out annually then on the average rate of return $50,000 a year, replacing your income. If we take just a normal, let's take a 30-year-old couple, and they've gone through this, they have a couple kids, they've gone through this life insurance thing, and they've gone through the financial piece, and let's say they make it all the way, their kids are now grown, they're off to college, and they no longer need this replacement of income. But if this gentleman that in this example dies, then his wife can make it and take care of her kids by replacing his income. We also don't...
So in that case, should she get the term life or the whole life?
All right,
I'm confused on the two.
So cash value, any cash value policy you want to stay away from. You really want to keep your insurance separate from your investments. Okay?
Oh, okay.
So cash value is probably the biggest ripoff in insurance that there is. There's a few reasons for this. One, it's very expensive. It has very high fees, and it has very low rates of return. But the biggest ripoff is that, let's say you had a $250,000 policy, and your husband dies, and you get a check for $250,000. You don't get any of the savings that was put into it. They take that out and they give you the $250,000. So what you could do instead is buy a term policy, let's say a 20-year term or a 30-year term policy, and for a cash value, you'll pay on average, a healthy person will pay about $178 a month for a $250,000 policy. A term policy, you'll pay about $13 a month for. It's extremely cheap. The insurance agents don't make a lot of money on it, so they don't try to sell it. What they try to push is this cash value policy because they make a lot of money on it.
And that would be the whole life.
Yeah, whole life.
Okay.
So yeah, like I said, whole life, universal life. There's a bunch of different ones. They've added new ones to make it more enticing. But if instead you paid $13 a month and you took the $165 a month that you were saving and you dropped it in an investment account, not associated with insurance, you could make hundreds of thousands of dollars off of it. And then it would be yours. And then if you died, you would get the payout for the life, or your spouse or your beneficiary would get the payout for the insurance, and they'd have all this money that was invested and you wouldn't lose it. I mean, you can look it up in Forbes magazine or Money magazine. All the magazines say term is the way to go. So you want term, you want good term. So again, 10 times your income so that it can replace your income.
And so that's really used for your death. It's not really life insurance.
Yeah, it's really death insurance. It's just not it's not as nice of a way to say it, right? Yes, it's used for your death when you die. So yeah, this isn't like burial insurance or anything like that. It's just burial is another thing that you kind of want to stay away from. Just take some money, invest it. When it's time to die, when you die and pass, whoever's taking care of you or taking care of the situation will have much more money if it's just invested than rather than like prepaying the burial expenses. So
we've gone over a lot of different things with the insurance and stuff, and I want to talk about something that's not really related to insurance, but identity protection. Is this something that we need to worry about, something that we need to invest in?
I think that everybody should have identity theft protection. Now, there's a big difference between identity theft monitoring and identity theft protection or credit monitoring, because all they're doing is seeing something happen. They're not protecting you. And the biggest thing is that they don't help you once it's found.
Oh, really?
Most of them, if you just have monitoring service, you spend all this time after the fact making phone calls, working with all these people, and Dave says for his whole team he gets identity theft protection for them so that they handle the cleanup, because it becomes a big mess, and it could be a big mess for a long time, and he doesn't want his employees having to deal with that while they're working. Right. So, excuse me. So you want identity theft protection, not just monitoring. Another good tactic to handle some of this is credit freezes. I don't know if you've heard of these credit freezes. So you can freeze your credit, and so you have to freeze with all 3 credit bureaus. You can't just do one. There's usually a a small fee per state. Some states are free, and then some states, depending on your credit situation, if you've been compromised, then they will then do it for free if you have proof. But you have to do it with all three agencies, and you can freeze your credit. And that means no new accounts on your credit can be opened. And when you want to open a new account, you call them and you thaw it, and then you have to refreeze it.
I see.
But it's a cheap fee, and it's a good way from people being able to open things in your name.
Wow, you've really covered a lot of things. But our takeaway before we close the show on insurance is, what would you suggest for my viewers?
Just remember the things that we kept repeating. You're going to cover the small stuff. They're going to cover the big stuff. Don't be underinsured. Make sure that you have enough liability and you have enough insurance to cover you when something big happens. Don't worry about raising your deductible a little bit. Don't ever reduce that max benefit. Get as much benefit as you possibly can out of it. Make sure that you have it. Stay away from some things I wanted to mention was like credit life insurance, so that your credit cards get paid off. It's almost like this PMI that we had talked about before with homeowners. It's not to cover you; it's to cover the bank. So stay away from credit life. Stay away from gimmick policies like cancer. You know, your husband or your wife needs the same amount of money whether you had cancer or you didn't have cancer. So make sure you just have adequate life insurance. Accidental death, prepaid burial expenses we talked about, mortgage life insurance. You don't really need, you just need to be able to have the adequate amount of term life insurance. Now, some people, if you have medical issues and they won't give you life insurance, a good place to get some money is through mortgage insurance. But for generally speaking, just have adequate term life insurance. So any kind of duplicate insurance, just stay away from.
You know what? Thank you so much for joining me today. Again, I've really learned a lot because I was totally confused about the whole life and the term life insurance, because I know I need to get some additional insurance. I'm so glad you came today. And I want to thank each and every one of you for watching my show, A Better You, here on Public Access 21, every Wednesday night at 6 p.m.